Hey everybody, happy Sunday and welcome to episode 4 of the Stock Trading Pit Season 3. Today's agenda, we're going to have 4 segments as always. Segment 1 is going to be talking with traders. Dan interviews James, aka Stock Chart Art on Twitter. You may have heard of him. Really a great trader and chartist on our platform. Segment 2, broad market recap as always, SPY, QQQ, IWM, and VIX. Segment 3 is going to be finding an edge with Jonah Lupton. I interviewed Jonah about how he finds these fundamental plays, but then applies the charts to them after he goes through that fundamental process. Segment 4 is going to be looking at some weekend chart requests. We're looking at 5 different charts today. So sit back, relax, and let's get started.
Welcome, everybody. This is Talking with Traders. I'm Dan Ushman, and I've got a very special guest with me, James Gillen, or as you may know him on Twitter as Casualty War, or his brand name Stock Chart Art. James, welcome. Thanks for being here.
Yeah, man, it's a pleasure to be on your show.
Definitely, it's a pleasure to have you. So you're a very talented chartist. I definitely enjoy a lot of your work, and you've taken FinTwits kind of by storm over the last year. Building up a impressive following and making some really amazing calls. So thank you again for being here. First question for you. How'd you get into trading? What brought you into this world?
So I actually tried my first go at trading about 4 or 5 years ago.
Okay.
I had absolutely no idea what I was doing. I wanted to be a day trader. I wanted to make a couple of $100 to $1,000 in one day. I saw other people doing it. I thought I could emulate it. It turned out to be a financial disaster. I lost about somewhere between 70 to 80% of my account. It was a very depressing experience. The thing with trading is we take money that we've worked very hard for. It could be years of work, of savings, and if you don't know what you're doing when you're trading, if you don't have risk management, if you don't have position sizing, if you don't know what you're doing accurately, you could literally lose money that you've worked your entire life to save in weeks, in months. So, that's why it's so important to, have an understanding of markets, have understanding of stocks, and to have discipline in your action on a daily basis. So
it reminds me of the rule of 90, which goes something like 90% of new traders lose 90% of their account within 90 days of their very first trade.
Yeah, that was me.
Me too.
And so I sort of quit and turned my back on trading at that point. And then 4 years went by. About a year ago, I got laid off from my job. I was sort of looking at the markets because I saw things were coming down hard and fast. And just the way that I look at things, I was looking at it as an opportunity to get back into the markets, especially in great stocks that were at a discount price. And that's where my journey really began. I started out with a small account. In about a week or two, the same thing happened that happened 4 years ago, but this time I lost 50% of my account instead of 70%.
That's better.
Instead of going into a depression about it, I sort of had this fire and this spark that went off with me because I wanted to trade and I wanted to trade successfully, and I was willing to take whatever steps and whatever education that it was going to take to get there. So at that point, I joined a live trading room. You might be familiar with Scott Smith at Live Trade Pro. He's absolutely amazing. He's an amazing mentor. He's an amazing trader. And he really put me on the right path at that point.
So I'm curious, what lessons did you learn that helped you improve from your early trades?
I think one of the most important aspects that I learned from Scott was emotional management when it comes to trading. In the past, if I took a loss, it took an emotional toll on me. And when you allow that to happen, you don't want to let go of that loss. You want to hold on to it. You want to add on to the position as it's going down, and it becomes a even bigger losing position.
Mm-hmm.
And the emotional weight that carries only makes you make worse decisions down the line when you're trading. And what I really learned from Scott the most was emotional discipline when it comes to trading, to really detach yourself emotionally, to have a predefined plan, to know what your entry point is, to know exactly how much you're willing to lose, what your stop's going to be, what your position size is going to be in comparison to the total of your account, and to have all these predefined aspects in place, before you go into a trade. You need to have a plan at all times, because if you don't have a plan, then the market's going to take you over and over again. And I think that was really, one of the most critical aspects, the psychological aspect and risk management.
Do you tend to day trade or swing trade more often? What's your style? And do you use equities or options?
No, I strictly trade common stocks. I'm more of an intermediate to long-term swing trader, position trader. I usually hold on to stocks for a couple of months, 6 months, 9 months, as long as the trend stays intact. And I see that there's a reason technically to hold on to the stock. I want to catch the bigger move. I don't want to just catch a small little piece. I want to get a nice big chunk out of the move, and that's the strategy that's worked for me over and over again.
Definitely. Do you tend to buy high, sell higher, or do you prefer to try to buy low? And are you looking for bottoms or momentum? I guess is what I'm asking.
Yeah, well, what's really funny is a lot of beginners and rookie traders, they think that buying a stock that's at a super discount and that's in a steady decline, that you're getting the stock for cheap and it's going to go back up, when it actually tends to be the opposite. The stocks that are constantly hitting new highs are much more likely to continue to hit all-time highs again and again.
That makes a lot of sense. Is there a particular pattern that you tend to consider your holy grail?
I absolutely love W bottoms, double bottom setups. I love trading pennants. I love trading triangles. But recently one of my favorite setups has really been the falling wedge setup. There's been some monster moves, especially the Holy Grail setup, when that stock falls back to the 21 EMA within a specific pattern, forms a hammer off the 21 EMA, breaks out on high volume, and it just rips from there. You look at Futu, the move that stock did. You look at BLNK, that was a Holy Grail setup. That thing was an absolute monster. I think went up like 25% in a day. It pulled back a little today because obviously the markets were a little bit toppy and we needed to pull back a little bit. But I'm a pattern trader. I'm a breakout trader. I look for specific patterns. I look for a specific criteria, especially what I'm looking for within a pattern. I'm looking for a pattern, and then I'm looking for a volume shelf to form around the price within that pattern, with a declining, drying up volume, because that means that the stock's consolidating, the sellers are drying up. And then when you get a large volume push through the particular pattern on high volume, that's a good indication that there is institutional buying stepping in and there's power behind the move.
Yeah, the volume shelf is popular. Everybody loves the volume shelves.
Honestly, TrendSpider is one of the reasons why I really sort of took my trading to a next level and got serious. I don't know.
I hear that.
I don't know if you know what my Twitter handle was before Stock Chart Art, but it was basically just a parody political account by I would go on Twitter for politics and to bullshit in that aspect. But my handle was Nancy Pelosi's eyebrows. And
those are some epic eyebrows.
So I was actually like at exactly the same time, Jake had sent me a message, and Mad Market, who are both phenomenal traders that I looked up to, that I've emulated their styles and in turn, turned that style into my own. And they literally came at me about 2 days apart from each other, and they were like, change your Twitter and get serious about what you're doing. People will take you more seriously. So, I changed my name to Stock Chart Art. I like the name, and I've never looked back since then.
It's a fitting name, man. Your charts are a lot like art. You've got a very distinct style to how you annotate them, and a lot of I've found a lot of the best traders out there don't have like a science or math background. They have an art background. Musicians. I know one whose family.
I play guitar.
Awesome. Yeah. It's having a different perspective, right? Than the typical kind of quant, purview that most people tend to have. So I'm curious, looking forward, I mean, today's been a crazy day for those watching. You'll see this on Sunday, but it's Wednesday, right after market close when we're recording. Today's been crazy. What are some sectors that, you're looking into going forward? Any names or industries or anything like that?
I think energy and EV are two very interesting sectors at the moment. I mean, I think energy is gonna skyrocket within the next couple of years, especially solar. The fact that we've been in a specific climate due to coronavirus, a lot of the world has been shut down. Energy consumption isn't as high as it used to be, and once the world gets 100% back to normal when it comes to travel, when it comes to our daily lives, I just feel like there's going to be a huge demand for energy that we haven't seen in a really long time. And I think that's going to really move the markets in specific sections, especially like solar, because obviously we have a Democrat president. They have a lot of green movement ideas, and they want to, sort of go in that general direction of switching a lot of things to electric. I know that Joe Biden, for example, today, I don't know if it was an executive order or legislations, but they want to turn all government vehicles into electric vehicles.
Interesting.
And that's only, he's only a couple, a week or two in office, and he's already making those kind of decisions. So it sort of just gives you a trajectory of where we're headed the next 4 or 8 years.
That's interesting. That's almost like a fundamental macro kind of purview. Do you tend to do that kind of thing often, where you're looking at kind of the macro, the financials, the actual fundamentals of the world, and then going into charts from there? Or do you sometimes look at charts first and then look at those trends?
Honestly, I would say that I have a mixed strategy. I go back and forth. If something makes sense to me from a bigger point of view, and from a macro point of view, then absolutely it's going to give me more conviction about a trade or about a specific sector or about a strategy that I have. But
I think that's great. I think a lot of new traders, have this, I don't know, preconceived notion that it has to be either fundamental or it's technical, right?
No.
And there's nothing in between.
But the thing is too, like when I'm trading stocks and the stocks that I'm looking for the best. I'm looking for the best stocks that are out there. I'm looking for the stocks that have the strongest relative strength in their particular sector, that are showing earnings increases, averaging more than 70% in the prior 3 quarters during strong bull markets the way we have right now. I'm concentrating on stocks that have powerful earning gains of 40% to 500%, that have sales growth of at least 25%. And then you have to look at the institutional aspect. How much institutional ownership is in that stock? 0 to 250 is sort of the sweet spot. And you look at a stock like Fubu, for example, or PLTR. You could see over over the last 2 quarters, you could see that the institutional ownership of those particular stocks has stepped in. So the more institutional ownership that steps into a stock, especially in its infancy and in the beginning, the more it's going to move that stock. At the end of the day, it's not retail traders like you and me that move the market. It's the institutions. And what we do is we determine what they're doing and we catch the tailwinds.
Absolutely. Except GME. Retail traders are moving GME today. So tell me about a trade that you've taken recently, something you're really proud of.
So recently I would have to say PLTR is a prime example. I've sort of been pounding the drum about that one for the last month while it's been consolidating. The funny thing is a lot of people think that if the stock is within a pattern, and it has a minor breakdown from that pattern, that the stock is breaking down. A lot of the time it's not. The stock is just further consolidating and forming different support or different resistance within that pattern that it was, or it might be forming a completely different pattern. For PLTR, the way it was formed with the support and resistance lines, a lot of people thought at one point that it was breaking down, but the way that I looked at it was that it was just further consolidating and further forming. That turned out to be an excellent trade. It had all of the different aspects that I looked for. It had the declining volume that was drying up. It had a beautiful thick volume shelf that was forming around price within the bullish pennant.
Yeah, man. I got shook out of Palantir in that consolidation. So I was really happy to see, good people, stay in and catch it.
Yeah, I did too. I got shaken out at one point, but that's what we have stop losses for. I'm not afraid to lose 8% on a trade because the majority of the trades that I take, I'm making 50%. I'm making 70%, 80%. A lot of the gains that I locked in this year, 400% on Tesla, 250% on Livongo, and there was a couple of other trades that I locked in 300, 200% gains. So
Livongo was a monster. I got shook out of that one. I sold that one way too early. I got out at like $40. I was like, So, well, cool. That's really, really good info. Thank you very much for sharing that. We're running out of time. I'm getting yelled at here. So, last question for you. And this is for all the newbies watching, and there are lots of them. What advice would you give someone brand new to trading?
Somebody brand new to trading, I would tell them that the most important things is there's basically 3 things: risk management, position sizing, and your emotional acumen that you need to learn to detach yourself emotionally from a trade and look at it as a transaction, that you have a predefined plan before you enter a trade. You know what you're willing to lose. The thing is we use stop losses to protect our downside, but at the same time we have unlimited upside for that trade. So when you weigh the options, you could lose 8% on a trade, but you could gain 50%, 100%, 200% on a trade. So at the end of the day, if you lose 8%, it's not a big thing if you're using proper position sizing. A lot of the things that beginners do wrong is they use too big position sizing. They use 50% of their account, or they use their whole account in one trade. And I just don't advise that. You need to have discipline. You need to use risk management. You need to use proper position sizing. And, if you don't know what you're doing at first, join a trading room of people that, know what they're doing, know what they're doing and learn how to trade the right way.
That's really good advice. I'm a big proponent of position sizing. I have my personal small, medium, large sizes, right? And depending on conviction, I'll go small, medium, or large, and it's in dollars, right? And I just try to stay there. And I think that's really good advice for everybody. Thank you again, James, for being here. I appreciate you.
Yeah, Dan, it was a pleasure. Thanks for having me on.
Definitely. And for those watching, if you wanna get to know James a little bit or learn a little bit more about how he trades, he did just launch a trade room called stockchartart.net, and we'll put a link to that and his Twitter in the description. So thank you again, and I'm going to pass it back to Jake for the next segment.
All right, Dan. Thanks for having me on. I appreciate it.
Alrighty, into the broad markets. This week was one for the record books as far as just weird stuff happening, short squeezes, market going down. And a lot of people wonder, why did the market go down if all these other stocks were going up? And a lot of it was simply the fact that there was so much money going into these short squeeze kind of plays that a lot of that money was being funneled out of the broad markets, not only for that, but also because if people are getting short squeezes, they may be getting margin calls on some of these good quality names or even some of these ETFs that they are holding as collateral. So that's what we saw this week. It was pretty fascinating to see play out. And the main thing that I wanted to point out here on SPY, if you guys have been watching over the last few weeks and even months, we've been pointing to this breakout from the election as an anchored VWAP place to anchor from. And you can see how well this acted as a level of interest in mid-November, but also we almost got right down to that point around 367, 368 today. We barely missed it, but you can see that I anchored the volume by price from this capitulation point on October 30th, and this actually acted as a nice bounce area as well. Remember, all of these shares that are holding around 368, they were just holding at decent profits up here at 385. So as the price gets back down to this level, everybody's back to break even and the price is able to bounce, not necessarily because buyers stepped in, simply because supply is drying up. So we'll see what happens going into the week ahead. But the biggest thing here is this ascending wedge that broke down. If you remember, we were talking about this being really close to either breaking to the upside or the downside. And we did break down through this support zone this week. And you can see that we did have a slight uptick in volume compared to the previous week, but really not a ton of volume for such a decent sell-off. So we'll have to see what happens into next week, if this is a fake out or if this is the start to a new chapter in the market, at least in the short term. Let's go on to the Qs and we'll see something pretty similar here. The one thing I want to point out here on the Qs is the fact that we tested this 1.618 extension perfectly. And it was just another case study on the fact that these Fibonacci extensions are very important when looking at the market, and they become a self-fulfilling prophecy a lot of the time. So not only that on the weekly side of things, a hard rejection, but also on the daily side of things, let's move the anchored volume by price to the start of this broadening formation. And you'll see that we pretty much moved right down to this volume shelf, pretty much the point of control dash volume shelf here, pretty much closed right at that point of control. But we did kind of move around within these other volume nodes and finally caught somewhat of a bounce into Friday, but you can see how big the volume is here. And honestly, is this exhaustion volume? Was that the end of it after a crazy week? We're still within this area. We still are holding this support, at least on the trend lines for now. Support's only going to be support until it proves itself. And at this point, it did today. We had that little bounce, but we'll have to see if that continues into next week. Now, going into IWM, we have the breakdown of this ascending wedge here. And you can see here that we are starting to really potentially break down through this volume gap. So if we anchor the volume by price from the start of this ascending wedge, you'll see that there is this volume gap below, meaning there's not a ton of liquidity until we get down, let's say, maybe to the 195 area. And so this is something to consider going into the week ahead. Risk is definitely starting to come off here in the markets, and you can see that through IWM starting to break down. Now, on the weekly side of things, we did get rejected right at this 1.618 extension here as well. So just a great example of being able to use these 1.618 extensions when you are kind of having price discovery, meaning that there's really no other prices that we can look at in the past. These are all-time highs, so we really have to use these 1.618 extensions. And this was just a great example of price respecting these areas. Now, going into VIX, if you guys remember last week, we were talking about VIX hitting these higher lows while SPY was hitting higher highs. So as you can see here, we've got this this higher low type of setup here, and then finally this resolve to the upside. We also talked about this gap below, but also the gap above, and the gap above was the one that finally hit first. And we'll have to see if that continues into the week ahead, or if that was kind of the main event for VIX. The one thing I want to point out here is VIX is something that's not really chartable, at least a lot of the time, but you will see these correlations, which is pretty interesting. The fact that we did move right up to this longer term resistance line here on VIX shows that there are some times where VIX will respect these levels, and this is a good example of that here on the weekly side of things. So what a week it was. Some really crazy moves, some big money made, some big money lost. But that's the market for you. So that is the broad market segment. Let's move into the next segment. And the last segment, as always, we'll go over some chart requests. And this week, we're actually just going to go over the chart requests from last week and go over what worked, what didn't, so we can use it as a learning opportunity. So let's move on to the next segment. And thanks for watching. Alrighty, into segment 3, finding an edge. We have special guest Jonah Lupton with us. Jonah and I do quite a bit of webinars together, and I'm glad to have him on the show to talk about how he finds an edge in the market. Not only just from his fundamental perspective, because for those that follow him on Twitter, you'd know that he really is into that side of the process of finding stocks, but also how he looks at the charts and finds entries and exits and which indicators he uses. So Jonah, thank you for joining. And let's start off just talking about, what is your process in finding a stock before it even comes on the chart and before that analysis even starts?
Hey, Jake. So thanks for having me. So like you said, I'm definitely more of a fundamental guy, but I do use technicals to either help me figure out the right entry price or possibly an exit or a trim. But when it comes to finding stocks, so my strategy has sort of changed over the last 6 months. With the pandemic, there was obviously a lot of acceleration in certain trends, e-commerce, digital payments, cloud, right? The whole work from home thing. And that played out very well for anyone that owned those stocks or jumped into them and went overweight on them. But those stocks just rallied so much last year. I mean, in some cases up 300, 400%, 500%, if you're talking Zoom and some others, to the point where the valuations just got so stretched. And I've seen this before, and I just felt like there needed to be some consolidation in some of those names where the fundamentals had to catch up to the valuation, or the valuation had to come down to the fundamentals. So I did do a lot of turnover in my portfolio at the end of 2020. I also was in a very low tax bracket last year, and I'll be in a higher tax bracket this year. So I wanted to take those gains in 2020, where those capital gains wouldn't hurt me so much. So that's another reason I also turn over my portfolio a lot. But then over the last, let's say mid to late December, I started positioning my portfolio into what I thought would be, my best performers for 2021, which, has been a lot of small cap growth stocks. So I felt like the larger cap stocks really led the way the last couple of years, and now the small cap stocks kind of have their chance to shine. Some of them are putting up very strong numbers, yet selling at significantly lower valuations or multiples compared to some of the larger, competitors in their space. So I felt like that gap had to narrow as well. So I've just become very bullish on small caps. And then as I started writing a newsletter and I opened up a StockTwits room, it became pretty apparent that other people also love or want to try to find those small cap stocks that are growing 40, 50, 60% that nobody else is talking about. They're not on the radar. They're not on the watch list. There's really no analysts covering them. These CEOs are not coming on CNBC and talking about their companies and their strategies. So I felt like I had a good opportunity to kind of focus on that small cap space. So kind of small cap / mid cap, under 10 billion is what I'm focused on now. Companies that are, doing something innovative or disruptive. They're not going to be the only company in their space. But then I run into a problem. Like if I still want exposure to cybersecurity, I'm having a very hard time finding a cybersecurity company under 10 billion that's growing as fast as CrowdStrike. So like, why am I going to give up on CrowdStrike just to force myself into a smaller company? So, same thing with Square, same thing with C Limited, same thing with DocuSign. So I'm not going to give up on the large cap leader in that space just for the sake of finding a smaller company. So my portfolio was still kind of, 25% large cap, 25% mid cap, and then 50% small cap. So I start with the fundamentals. Typically, I'm finding these companies through stock screeners, podcast interviews, maybe some analysts or research reports that pop up on the radar. I'm on a whole bunch of different Substack newsletter lists, and there's other people out there that are also writing about these companies and trying to find them and kind of bring them into the limelight. So, but I would say overall, where I'm finding them first is stock screeners. So I usually, I go into Atom Finance, which is the URL is atom.finance, and you can put in your criteria for market cap, revenue growth, earnings growth, if there is any, and that'll bring back a whole bunch of stocks, anywhere from maybe 25 to 100 stocks. And then you just have to start going through them and kind of picking out the ones that are in sectors or industries that you might actually understand. Like, for instance, I don't go anywhere near biotech. If it has to do with drug development, drug discovery, FDA approvals, any of that stuff, I just stay clear because it's too risky. I'm not the person to really deep dive on those industries. But one of my bigger positions right now, or actually my biggest position right now, is a company called DermTech. But that's genomics, that's clinical, non-invasive, nothing to do with drugs. So that's kind of where I draw the line. Is I'll go as far as genomics. I just won't go any farther than that into biotech. And then there's plenty of other industries like semiconductors. I've never really understood semiconductors. I couldn't tell you the difference between Intel and NVIDIA and AMD, from a product standpoint. So I just don't go anywhere near that industry. I'm sure I could probably learn it, but at this point, I've decided to stay away from it. So there's still certain industries that I focus on and others that I stay away from.
Got it. And are you focusing so you mentioned, for small caps, less than 10 billion, is there kind of a max or a minimum that you'll go below? Like, will you go below a 100 or a $1 billion market cap, or is it kind of within 1 to 10 billion?
Yeah, I'll definitely go under $1 billion. If I'm just thinking through, so DermTech, when I first jumped in a couple months ago, that was under $1 billion. Now it's right around $1 billion. Mohawk, which is one of my biggest holdings, I think that's top 5 right now. That's actually, that is number 5. I think that was a $250 or $300 million company when I jumped in. Although I expect them to be a $2 or $3 billion company in a couple of years. But I got no problem jumping in. I think where I'm having an issue is the micro caps, and I'm not even sure micro cap if that's under 100, under 150, somewhere in that ballpark. We're talking companies at that point that either have no revenues or 5, 10, 15 million a year in revenues. In most cases, there's no analyst covering those stocks. So you don't really have any guidance. You're kind of going off of the company's, own projections or investor presentation. But the other issue for me, and this is something that I'm kind of struggling with right now, is because I've chosen to be very transparent with my portfolio, and you can see my portfolio that I update every day. It's on a Google sheet that's pinned to my Twitter account. So as soon as we get off this, this interview, I'll go update that with today's prices and allocations. So if I'm going to be transparent and I'm going to take a new position in the company with a really, really small market cap, I have to expect other people are probably going to follow me into that stock without doing their own due diligence. Mm-hmm. So that kind of raises the stakes for me a little bit. So I'm probably a little bit more cautious about going into the really small companies, knowing that. Now, if I wasn't transparent and I wasn't posting my portfolio, then I probably would be a little bit more aggressive with those microcap stocks. But for now, I'm kind of setting the bar at like 250 million, although I did start a position recently in a company called Dario Health, which I think could be the next Livongo. Now, Livongo sold this past summer for 18 billion, and Dario is I think $125 billion company, so they have a long ways to go. But, they're doing, digital health, glucose monitoring, and then they just did an acquisition this morning for 30 million to bring on a new product line. So there's a lot happening in that small cap space that just doesn't get a lot of attention. And I think if I can jump in there and find these explosive growth companies before the institutional investors get a chance to take a look at them, or before they're even big enough for the institutional investors to jump in. That's another thing. If you're a $20 billion hedge fund, or if you're ARK, right? ARK's innovation ETF is now $20 billion. They can't buy these small companies anymore. They're just they're too small for their ETF. They, you know, they could probably only take a 9.9% position. And, you know, when you're running a $20 billion ETF, taking a 9% position in a $100 million company doesn't move the needle at all. So,
yep, that makes complete sense. And yeah, no, that completely makes sense as far as the size of the company you're looking at, and with your following, it's always important to kind of, you know, be cognizant of other people probably blindly following, which is kind of an issue on FinTwit a lot of the time, but it is what it is. So now that we have a general idea of what you're looking for in the fundamentals, let's go into the charts, look at some of the indicators you're looking at, kind of look at the technical side after you've found these stocks from a fundamental perspective.
okay. So the green here is the 10-day, the purple is the 20-day, and the, I don't know if this is yellow or orange, but that's the 50-day. And then the Bollinger Bands, I use the 2 standard deviation, 2.5 and 3. So I use the Bollinger Bands to guide me on when to start trimming a position, because it's just gotten overbought and a little extended. And then typically I'm adding when a stock comes back to one of the moving averages. So, you know, like I mentioned, DermTech is my largest position right now. Now, I love this stock for the story and the genomics smart patches and what I think this company could become over the next 3, 4, 5 years. So I'm not super sensitive to the technicals right now. Like I have no intentions of trimming this stock anytime soon. I'm just going to keep adding to it. But over the last couple of days, as the stock, I mean, you can see where it had a huge run right here. And that's because they got the gold stamp of approval from the NCCN, which is the National Comprehensive Cancer Network. So that's like, you know, in the world of genomics, and that's what you want. So that's where the stock really took off. And I know a lot of people have been waiting for this pullback. And then over the last couple of days, we got to pull back to the 10-day. And then today we got to pull back to the 20-day. So yesterday I added a lot at the 10, and then today I added a lot at the 20. So I'm pretty loaded up on this stock right now. This is actually the most I've ever owned in a single stock in my life, is in DermTech right now. But that's just, you know, my conviction in this company, talking to dermatologists, doing the research. I have no doubt this company is going to be a monster in a few years. So I'm just going to keep adding on pullbacks. And, you know, if this thing pulls back to the 50-day, which I doubt it does, but if it does, I'll keep loading up the whole way. So, you know, this is maybe not the best example, but like, let's go back. So Futu, for instance, I'm not sure if you can actually tell on this chart, but yeah, you probably can't because it's been too long. But back in, I think it was mid-December when I wrote about Futu in my Substack newsletter, it was just coming down, or it had just come through the 20-day, and it looked like it was going to come down and touch the 50-day, which it did, which is when it got that massive, okay, right here it is. It's like, yeah, so end of December, I don't know. Yeah, so I started buying it in here when it was coming through the 20, hit the 50, and just went into launch mode. And I mean, I thought Futu might hit 100 this year. It ended up hitting 100 by the end of January. But this is a tricky one. I mean, I love the story. I love the fundamentals. You know, the kind of the Asian Robin Hood. I mean, there's a lot to like about that. But you know, when you add the Bollinger Band, you can see where this stock is, you know, was starting to get into, you know, crazy overbought, overextended territory. Now, I didn't trim any yesterday. So if this had been 2020, I probably would have started trimming right around here when it got up into the 120s yesterday or the day before. But because this stock took off when it bounced off the 50-day, I had a chance to add a couple times in the 60s and the 70s. But I think my last add was right around here. So as it rallied from, you know, 70 all the way up to 120, I didn't get a chance to add to the position. So whereas I did get to add to a lot of my other positions. So as, you know, money was coming into my account, I'm adding to all my other stocks. I'm not adding to Futu because I was waiting for this pullback. You know, it kind of dropped from my top position down to like the 10 or 12th. So I figured, okay, there's no point in trimming it because once this thing does pull back, I will start to add it and get it back up into the top 5 or 6 names. And that's sort of what we're looking at right here, where, you know, here's the 20-day in the green. It didn't quite come down there today, but if it comes down there tomorrow in the next couple of days, you know, that will be a significant add point for me.
So generally, when you're looking at entries and exits, it's really a function of moving averages. And are you using the Bollinger Bands as a sell point or just to gauge overextension?
Yeah, mostly trimming. So, today was a little bit different, and I know, some people may not realize that we're recording this on Wednesday. I'm not sure if I'm supposed to say it or not, but I'll use this as an example. So Fastly, am I allowed to say that, by the way?
Yeah.
Okay.
Yeah.
So today I actually sold all of my Fastly. And for anyone that's been following me for, the last 6 or 9 months on Twitter, you'll know that I've been a really big Fastly bull. But that was also when Fastly had TikTok as their biggest customer. And when TikTok left because of geopolitical reasons, that really did change the story for Fastly, because 12% of their revenues just literally walked out the door. So I thought Fastly could do 450 to 500 million in revenue this year, 2021. But with TikTok gone, they're going to have a hard time hitting 400 million. So if you look at today, I think there was a short squeeze going on with GameStop and all these highly shorted stocks where I think some of the hedge funds were starting to cover their positions. And I'm not exactly sure what the short interest was on Fastly, but Fastly was up, I think 12 or 13% at one point today and got up into the 120s, which took the market cap up above 13 billion. And if you just divide 13 billion by 400 million, which is the high end of estimates this year, you end up with about 33 times sales. And even if they do 400 million in revenue this year, that puts them at about 50% revenue, not even 50%, because they did 300 million this year. So even like best case scenario, if they hit 400 million in revenue this year, that's like 33%, maybe 35% revenue growth over last year. I have no interest in paying 33 times sales for 35% revenue growth. Like, to me, that doesn't make any sense. So I still love the company. I like the products. I love the customers, but sometimes these stocks just get ahead of themselves. And, if the stock is up 12, 15% in a day for no reason, sometimes it's just a chance to sell. So today I closed out my position in Fastly at 120, 150. And if it pulls back, 15, 20%, I'll buy it back. So when I close out a position, I usually ask myself one question. If the stock drops 10% tomorrow, will I buy more? And if the answer is no, then I sell the entire position because it means I don't love it enough, or I think it's so overvalued that even a 10% pullback isn't enough to get me to add to it. So, and in this case, when Fastly was trading at 120, 150, if it had pulled back 10%, I think that would have brought it down to like 108, 109. I would not have added to Fastly at 108, 109. So time to sell it. I asked myself the same thing in Nanox today, right? So Nanox rallied today up into the 90s, very interesting company, interesting technology. They still don't have FDA approval, yet the market cap was closing on like 4.5 or 5 billion. So I kind of asked myself the same thing. If Nanox dropped 10% tomorrow, would I buy more? And the answer was no. So I decided to close out my position at 92. So, and I'm not always right on that. I mean, clearly these stocks could keep going higher. I mean, it doesn't mean there's going to be a pullback, but I have to do what's comfortable to me, comfortable for me and my risk management, since I'm always on a little bit of margin and I don't hold a ton of cash in my account. If I'm not comfortable with how, extended the stock has gotten and I'm not willing to add more on a pullback, then I should just close out my position and add to the stocks that I'm more bullish on, right? So I would rather close out my Fastly position, close out my Nanox position. I mean, I bought Nanox a month ago in the mid 40s. So I'm up 100% in a month. I mean, I got no problem walking away, with the 100% gain in a month, and I can take that cash and I can add it to some of my other stocks that, I think have more upside over the next 6 or 12 months. So that's kind of how I do it.
Hey, makes complete sense, and really appreciate you going through these different tickers to show how you use technicals on top of fundamentals. We may have 1 or 2 more minutes to quickly go over this one before our time's up. But if you want to quickly go over CRWD, let's do it.
Yep. So CrowdStrike, I mean, awesome company, not cheap. I mean, I think the price to sales multiple is somewhere in the mid 30s, but they probably are growing at 45, 50% still. I think they grew 80 or 85% last year. Absolutely, for best in class company for cybersecurity. But this is where it gets a little bit tricky because the stock did get up into the Bollinger Band area here. I didn't do any trimming. We got a bounce here. I was planning to trim somewhere if it got up closer to the 240s, 250s. It never got there. I think it topped out at 238 and then pulled back. Obviously blew through the 10 and the 20-day, and now we're getting close to the 50. So I mean, yes, that would be a little bit brutal to see it come down to the 187 area. But if we do get a pullback down into this range, down to the 50 in the next few days, I would load up on CrowdStrike because at that point, the stock is just way oversold and that could be a tremendous buying opportunity. So even though I'm still, I'm not super bullish on large caps anymore, and I am kind of, skewing towards the small caps. I mean, companies like CrowdStrike and Square and C Limited, I just love too much to give them up. So when they do pull back to these support levels, I'm just going to keep buying them.
Hey, makes sense to me. Well, this is really great info, and it's always nice to see how does someone who mainly focuses on fundamentals actually go in and use the charts to really look at their entries and exits, because as much as you look at the fundamentals, you still have to have a general strategy, at least on entries and exits, which sometimes you can't necessarily get from just a fundamental perspective. So
right. So I mean, and it's hard. I mean, we've been in such a bull market the last few months. It is harder to find these growth stocks that have pulled back to a moving average where you feel like you're getting a really good entry point. Sometimes you do have to chase a little bit, and then if you get a pullback, you just add to the position. So that's why I talk about starting a half position or a third position. So if a full position for me is, let's say 6%, I might start at 2%. And if the stock never pulls back, then it kind of sucks because I never get a chance to add to it. But, if I jump in and I try not to chase stocks. I mean, I try not to buy stocks when they get really overextended. I mean, if a stock is already poking through the Bollinger Bands, it's unlikely for me to start a position. But so, yeah, I mean, I'm not the best at technicals, but I think I've learned a lot in the last 6 months. And to be honest, I mean, using TrendSpider has helped me a lot. You guys make it very easy for someone like myself to get better, with the technicals and follow the moving averages and use the Bollinger Bands to help guide them. So I appreciate what you guys have developed here. It's first class.
Hey, thank you so much. Really appreciate it. And we're honored for you to be using it. And I know we have a webinar in the next couple of weeks. So for those that do want to learn more and, see what's going on at the end of February, we will be doing another Zoom call webinar like we did a couple of weeks ago, maybe a month ago at this point. And we will send out some more information about that when that gets closer to time. Looking forward to it. I'm sure we'll talk before then, but thank you again, Jonah, for coming on and talking about your strategy, both fundamental and technical. And let's move on to the next segment.
My pleasure. Thanks, guys.
Alrighty, let's go over some chart requests, which pretty much our last weekend's chart requests. We're just going over the same exact charts. As I mentioned in the previous segment, let's look at these charts and see what worked, what didn't work, and how you could have used some of these different TrendSpider features along the way. So pins, if you remember, we were talking about this ascending wedge last weekend, and we mentioned if you just put an alert on the top and the bottom part of this wedge, you don't really need to guess which way the price is going to go. Let the alert go off, and then you're able to take the trade from there and not have any bias on this particular setup. So a nice move down and then a little bit of a bounce on Friday. And you can see here that, this is something that may come back to retest this area above. This is where you'd go create an alert at this trend line above. And let's change the confirmation candle to the 10-minute. That means when the 10-minute candle touches this area, you'll be alerted. And we'll name it previous support, have it expire in 5 days, create the alert. And now if we go and retest this area, you'll know that we're potentially getting back up to a zone that we were recently just at. And we'll see if we continue up or if that's just going to be a retest for the continuation down. Now, on the weekly side of things, we have this pretty big broadening formation here, and it just keeps getting wider and wider by the week. And we'll have to see if this if this just continues to trade right within this this kind of mid range here, or we actually do continue down further. But that's not for us to decide. That's for the market to decide, and we just go with price action. Going into PLTR, this is one that did have a nice continuation up on Monday, and then you can see here that we actually continued up again on Wednesday before pulling back over in the last 2 days of the week. But not a lot of volume on Thursday and Friday compared to the volume we saw on those up days in the beginning of the week and late last week. So, this really kind of defined pennant is forming here, and we'll have to see which way price goes. On the weekly side of things, we did break through and test this 1.618 extension. We didn't get all the way up to the 2.618 extension, so we'll have to see what happens going into the week ahead. But you can see this pretty big volume bar here, which which is definitely showing that there is some conviction here on the buy side just by the price moving up with the volume here. But definitely a pullback in price. So this is where I'd really like to have one of those raindrop charts for the weekly side of things, and really looking forward to when that finally comes so we can see what's going on within this wick. Now, moving on to Amazon, this thing is literally stuck. Pretty much like every large cap stock right now, they're just pretty much stuck. Now, this is an example of something we can use going into next week. You can see here we've got this symmetrical triangle. This is something we talked about last week as well. If you would have had an alert right at this area, you would have been able to get an idea of what was happening here into last week when we were getting close to the zone. And you can see we never really closed through it. And going into the week ahead, we've got these alerts created here again to see if maybe the support alert goes off and we start to break down. We'll just have to see what happens into the week ahead. But this is why we have these alerts, so you don't have to watch price action constantly. Just set these alerts on each side, wait for the pattern to do its thing, and then you don't have to be biased or guess which way price action is going. You just let the price action tell you what's going on when one of these alerts goes off. Now, on the weekly side of things, we've got the symmetrical triangle here that's been here for quite a while. This volume shelf that continues to just literally show more and more shares aggregating here. We did hit a higher low here this week, so that's something to consider. And we did kind of bounce off of that point of control. But for now, we're literally just stuck, and we've literally been stuck now for almost 4 or 5 months. So this thing is definitely taking its time. On to Apple. Apple's a pretty cool case study of the volume shelf here. So we've got this nice trend line here that we bounced off of on Friday. And you can also see here that we have this volume by price that is creating this volume shelf here that we bounced off of nicely. And this is why it's important to use the shelf rather than just the point of control. The point of control is way down here at 128, but you can see here that we actually bounced around 130, 131, right when we started getting down to these shares that are back to break even. As the price was up in 143, 144 and pulled back, nobody has any profits, or at least not a lot of people have profits anymore now that they're back to break even. So that's something to consider when seeing these bounces. It's not always a bounce because buyers are stepping in. It could be that people just have no more profits to sell, so they stop selling, and that shifts the supply and demand curve. Now, on the weekly side, we have this this ascending wedge kind of forming, and I'll turn off the volume by price here. But you can see here that we are kind of getting close to the apex here. We still have a few weeks until this is either going to break to the upside or the downside. But a lot of the time, just set your alert on each side and let price action tell you what's going on. Slight uptick in volume, but still really not a lot of volume compared to what we were seeing in August and September. So that's something to keep in mind going into the week ahead. NVIDIA, this is one that really tested the patience of a lot of people this week, but also over the last like 5, 6 months as well. So if we do anchor the volume by price from the start of the symmetrical triangle here on the daily, you'll see that we are having trouble breaking through that supply above. Remember, anytime price is below this supply zone, it's going to be this volume shelf, it's going to act as a supply zone above. Anytime the price is above it, this is going to act as an area where price could bounce as people get back down to break even and supply dries up. Now, let's turn it off here on the daily and then turn on the volume by price here on the weekly. And this pretty much looks identical to Amazon. I was going to say Verizon for some reason. We've got this huge volume shelf. You can see here that nothing has happened over the last several months. And we'll just have to see if this breaks down. But if it does start to break down, you don't have a lot of liquidity below. So is this going to kind of exacerbate the entire move down if we start to move down? We'll just have to see. But all in all, not much to report here on NVIDIA. This would have been a great time to really just use the alert system here, especially on the downside on the support zone. Notice how I'm using these dashed lines to create a zone. But if you're just using one line, you just go to create an alert, you add that sensitivity, and you're essentially creating the zone just like I'm doing with that dashed line. So these are really useful, these alerts, both on trend lines, but also on moving averages, Bollinger Bands, anything on the upper side of the chart, you can create that sensitivity on. Going into Fastly. Fastly was a great case study this week on gaps filling above. Notice how this gap literally filled almost to the cent here on Fastly on Wednesday. And you can see here the same thing. You would have just put an alert right at this gap, and then you would have been alerted when the gap filled, and maybe that was when you decided to take profit. But being able to use this gap snake and this automated gap really allow you to just first see gaps a lot faster than you normally would, because the system's just finding all of them for you. But then on top of that, creating the alerts on these gaps makes it really easy to watch these areas and see what's going on. Now, on the weekly side of things, we still have this massive broadening formation. But at the end of the day, price has really not done anything here over the last 6 months or so. So a lot of stocks not doing a ton. And then you have your GameStops of the world and your AMCs that did steal the spotlight this week. But who knows if that's going to continue as maybe some of these short positions finally unwound, and we may not see those squeezes anymore. Last one is SPCE, definitely a nice squeeze here this week. You can see that we do still have a gap below, so something to consider here in the 28. But if I turn that off, you'll see that we did break through this ascending triangle resistance and had quite a move over the last few days. And you'll see here, if we look at the weekly side of things, we barely missed this 1.618 extension. That's kind of a function of this measured move in February down to March, pretty much the market crash from COVID. And this is a great example of just right clicking, creating an alert at this line, and you would have been able to at least create a little bit of sensitivity. We still didn't touch that sensitivity zone this week, but if we would have moved up a little more, it would have triggered the alert, and you would have gotten an alert through your phone or your email. So all in all, this has been a crazy week in the market. Hopefully, us going over some of these charts helps you understand how you can use TrendSpider to get an edge in the market and make some of these processes of technical analysis, as well as just watching the moves of all these stocks more efficient. Remember, we do have the 7-day free trial if you want to give this a shot. And if you have any questions, we do have the customer success team that will answer any questions, but also walk you through anything that you have questions on. So we really like to support our customers and make sure that you're comfortable using the platform as a paying customer. So that is always on the table there that you can use to your advantage. If you do have a question for us that you don't want to reach out to the TrendSpider team on the customer success side of things, our DMs are always open at TrendSpider. You just click the little envelope and send us a DM if you have any questions. And really just an absolutely crazy week. And hopefully everybody has a great week coming up. Remember that the market can be volatile at times. It doesn't always go straight up. And that's what we're seeing a little bit over the last week or so. And it could continue into the month of February. So everybody have a great Sunday. Thank you for watching. Happy trading into next week. And we'll see you next weekend.